So Bert, I always wanted to know, how does a hedge fund work? How do they make the decisions on what to invest in? What's the day-to-day? Are there any rules? Tell me, like, what's going on inside of a hedge fund?
One of the things that most hedge funds bring to the table for people is their pattern recognition ability. Basically, you're hoping that a hedge fund manager has seen something that's analogous time and time again and is able to say that a particular stock or a particular situation reminds them very much of another situation that worked out for them or didn't work out for them. I'd say pattern recognition is the bedrock of everything. And when you start with that, one of the things you find is that you don't necessarily want to look at the headline numbers, but you want to look at the numbers behind the headlines. And you've seen it before. If you've ever heard the phrase, "I've seen this movie before," that's exactly what hedge fund managers or successful ones are trying to say. That's how they work. And so you don't try to look back and say, XYZ company reported a terrible number. You want to look back and say, XYZ's headline was not particularly pretty, but underneath it, I saw bookings go up, I saw deferred revenues go up, I saw expense management kick in. These are the kinds of things that hedge fund managers are trying to look for, not what you can look for by taking the 15 seconds to read the headline numbers. And if you do that, that's a start, okay? You want to, second thing you really want to do is determine what are overarching trends. 5, 8 years ago, cloud was an overarching trend.
What do you mean by overarching trend?
Well, everybody was moving to the cloud, okay? It was something that was going to happen, and everybody who sold enterprise software was going to have to involve themselves with that, and if they didn't involve themselves with that, they would be toast, okay? So you wanted to see which companies were leading in the trend to cloud, which companies were leading in the trend towards SaaS, okay?
Software as a service.
Yes.
Okay.
And which companies were lagging. Got to get the trend right. If you can't get the trend right, you're never going to be successful. I don't care how good a company is that sells buggy whips, but if the automobile is the competition, the buggy whip vendor can't do much good.
Mm-hmm.
And so that's another basic premise that people have to look for. I think the third thing that you have to look for is inflection points. What's an inflection point in this business? Moving from on-prem to cloud is an obvious inflection point. Moving toward using AWS, Amazon Web Services, is an obvious inflection point. Moving toward creating your own cloud environment is also an inflection point. Moving toward creating a managed services offering is an inflection point.
These are for companies that, in your specialty, were in the enterprise IT space, for example.
But it doesn't really matter, okay? Inflection points are one of the key things that hedge fund managers do. About 10 years or 8 years ago, I misremember, Stevie Cohen determined,
SAC Capital, right?
yes,
Yeah.
that everybody, that a lot of people wanted to buy high quality organic groceries. And he put a major bet on Whole Foods Market. And for a time it was very successful, as you know. I don't know if he was able to get out at the appropriate time, but I can tell you that the trick was figuring out the kind of offering that Whole Foods was making 8 or 10 years ago would turn out to be enormously popular. And
He also, I remember 2 years ago, he wanted to buy Weight Watchers because Oprah got involved, and shares went from $5 to $16. I thought he was overpaying, but now Weight Watchers shares are over 50. So I guess, when there's a big change in a company, you have to be aware that, right, the shares could.
You're looking for inflection points, okay? I don't know Weight Watchers, and obviously, I think that's obvious looking at me.
That's funny.
But, and I'm not sure if I did, I would choose to buy their services, regardless of Oprah. But Cohen saw something that was an inflection point. You cannot make a particularly differentiated return buying things that everybody already knows about. That doesn't work. It may produce a decent return if the market is the way it's been over the past year, before last week. You could do that. But you're not going to differentiate yourself from everybody else.
How do you know if people know about something or they don't? Like some people, maybe a few people that are around you know about something, but how can you gauge if the word's out about this inflection point?
Well, that's a good question, and nowadays, fortunately for those of us that are not on the inside of the hedge fund world, we can look at Yahoo Finance, and Yahoo Finance has a tab called Analysts, and we can see how many analysts rate stock as a buy or a hold, and what the trend's been in that regard. So we're in a better position today to be able to say, hey, everybody loves this name. That's not necessarily something that would cause you to not consider it, but it's something you have to overcome. You have to overcome trying to invest with the crowd. Don't want to do that. Don't want to do that. So, for example, I would say you take a look at the estimates that people have. And again, it's relatively easy to do nowadays. If the estimates are such that they don't support a buy recommendation, and the price targets are such that they don't support a buy recommendation, that's when it becomes interesting to see if your pattern recognition skills tell you that the estimates are pretty far off base. And here you have to pay special attention to exactly what the company management is saying during conference calls and presentations, and why they're saying it, and the time frame in which they're saying it. And that's really a crucial element of the consensus says they're going to earn $1. But you look and you say, if everything works out the way they're talking about, they're going to earn $2. The stock's not priced for them to earn $2. You're betting against the crowd, and that's what you want to do.
What happens if the shares don't move in 2, 3, 4, 6 months? How long should you wait if you think you're right?
That's something you have to, I personally can wait a year, 18 months. What I'm really looking for is not so much whether the stock's moved or not moved, but whether the business is moved or not moved. If the things that I'm looking to happen, the things that I'm looking for to happen are happening, but the stock isn't moving, that's okay.
All right, so is there anything else? Are those the basic tenets on how hedge funds work?
Well, stop loss, okay?
Stop loss is selling something when...
I mean, no hedge fund that I have ever known will ever carry a loss of more than 20%. If something goes down more than 20%, it's gone. Basically, the reason is you've made a mistake. Fess up to the mistake, move on, take your punishment. Yes, you will lose on occasion, absolutely true. Yes, it's hard to do because people like to anthropomorphize their stocks, but they aren't your children. And
so you're treating a stock like a person. There's just really a ticker, you told me.
yeah, and that's one of the things I see people do is they say, "Oh, but it's..." No, it isn't. It's a company, okay? It is not your child. It is not your wife. It is not your mother-in-law. It is a company, and some do better at some times than others. Just admit that.
Okay, so to wrap it up, you got anything else to say about this topic?
Well, I think don't get scared.
Mm-hmm.
Okay? A lot of people, and I've seen this many times, they start the year and they make a couple of bad bets,
Mm-hmm.
and then they stop. And they second guess themselves and triple guess themselves. Don't do that, okay? You are going to make mistakes. It's inevitable that you're going to make mistakes. That's why you have the 20% rule. The other side of that is don't let a position become outsized, okay? If you have 10 stocks and one of them goes up 50 or 75%, trim it, okay? Don't let it become such a large percentage of your portfolio that if it runs into problems, it sort of messes with your head.
You were also saying to me, if you don't keep this 20% stop loss, meaning if you buy a stock and it goes down more than 20%, sometimes people say, stocks is not for me. Sometimes you were telling me before that a lot of people, are scared of investing because they haven't done the stop loss in the past, and they said, I lost half my money on this or that. Maybe you recommended hedge funds or to invest like when you have more than a certain amount of positions?
The larger the amount of money that you have to play with, the more positions you ought to have.
What is the minimum if, say, somebody has they have a $20,000 portfolio, and maybe they're worth $50,000? I mean, how many stocks should they put in their $20,000 portfolio?
Three,
In
my opinion. That gives them a little bit of size in each position. It gives them a little bit. I would prefer to see more diversification, but I would never try to... investing is a batting average game, okay? Well, I don't know about you, but the best hitters in Major League Baseball have on-base percentage of 50, 55%. What's the shooting percentage even from the foul line is 80%, 75%. If you don't have losers, you're not doing this right, okay? It's the golf concept, never up, never in, okay? And you should expect to mess up at least a couple of times a year and not let that worry you too much. And if you're diversified, it won't have the consequences it would otherwise.
All right, thank you very much.